Yeah, and one important point is that for this filing, the foreign entity has to have an authorized representative in India, and the requirement under Companies Act is that authorized representative should be a resident in India, and resident has been again defined as person who has completed 182 days. So this is where most foreign entities find difficult to, and what we've seen in some cases that they don't want to rely on an Indian individual who is not known or is a consultant like you and me. They would want somebody from their side who is appointed for signing all documents, etc. In that case, it becomes difficult for them to have a foreign national get appointed here, and that's where they have to find a local individual who either has a PAN number or is a resident in India to say that this is the person authorized. What we explain is that this authorized representative is only for the purpose of making submissions to the authorities. You can have one more individual who can undertake all the other activities relating to, especially in case of a PO or BO, maybe a contract signing or other signing authorities. But this is a practical difficulty which we see because in some cases clients insist that they want to have their own person who will be appointed as the authorized representative, and that person is more likely than not a resident in India. If there are any changes in the names, etc., or the key management people, you would need to essentially report the same to the concerned AD bank. And for branch offices, etc., that are coming from foreign entities that are coming from land bordering countries, they also have to make a registration with the DGIP in Delhi and also make an annual filing. In addition, there is an annual filing for LO, PO. PO has to submit an annual activity certificate, whereas a BO and a LO have to submit an AAC in the prescribed form at the end of the financial year, submitting their financial performance basically. So just on the closure bit, very quickly, earlier there used to be a specific approval that branch offices or project offices or LOs needed to transfer assets to any resident in India, but some years back, about 16, I think, in 2016, RBI said that you can only transfer assets pursuant to closure. And if there is no closure happening, then you need an approval for transfer of assets. So for ease of doing business, they had taken away the transfer of asset approval requirement, but only in case of a closure. And we handled this case where basically a branch office was transferring its business to a subsidiary of the same foreign entity in India. But owing to the fact that along with the assets, the liabilities were also getting transferred in a slump sale kind of a scenario, we went to RBI to seek a specific permission even when the branch office was getting closed. The AD bank did not take a call that liabilities can also be freely transferred. So that we had taken a specific permission for. Otherwise, subject to closure, transfer of assets is allowed. AD bank needs to be intimated and certain details need to be provided of that transfer, and then the closure process can be basically initiated with the AD bank, where also from the ROC you need a closure certificate which goes to the AD bank, and ROC would typically see that you have made all your compliances, etc., that were applicable, and they'll issue you a certificate of closure which goes to the AD bank, and then AD bank allows closure. So I was also going to cover outside India offices. Should I do that? Or so I just wanted to also take up a couple of cases that we handled. I talked about one where the transfer of assets and liabilities happens. Typically in case of a PO setup where a foreign entity has been granted a contract by an Indian entity, and that foreign entity has subcontracted through another foreign entity a part of the contract. So like Indian entities, foreign entities, Indian entities are also allowed to set up office outside India who do not want to go under the ODI route and set up companies. And typically it's not an approval process as such, because it is relevant for the banks outside India for the opening of the bank account. But you can approach the AD bank that you need to make a remittance to a bank account outside India. It is subject to the laws of the jurisdiction where you are setting up the office. Typically a representative office or a branch office can be set up, and you would have seen most entities opening trading offices outside India or appointing a representative for market study, etc., similar to a Liaison Office. Indian entities are allowed to make remittances subject to the limits that you see here. And typically, if you want to make remittances beyond these limits, there is an approval requirement again for that. Limits are not applicable, however, if the Indian entity has an EFC account or is a EOU or a STPI. Then these limits do not get triggered, but a DTA entity, which is remitting money, is subject to these limits, basically. Acquisition of immovable property is not allowed, but office space you can have on a lease basis outside India. Manufacturing activity is a big question mark for these offices. Typically, we have seen that they would be set up for trading purposes or for services or doing any other activity but manufacturing, because manufacturing becomes complicated from the local licensing perspective in that jurisdiction also. So we've not seen manufacturing offices set up, as in like a branch can set up in a special economic zone. Maybe in Dubai somebody can set up, but typically otherwise an office outside India would not be undertaking manufacturing activities. And what happens is that once you are closing the office outside India, or if you have not been able to appoint a representative or start operations after you set up that office outside India, whatever money has gone has to be immediately brought back. And otherwise also a branch office which is outside India has to remit surplus back to India. We've handled a case where one of the leading IT companies in India, ITES, has opened a branch office in US. They acquired some employees from a subsidiary outside India, and then they ended up making excess remittance beyond these limits. So AD Bank came back and their auditor also qualified that these are not in compliance, and somehow they made a mistake on counting the turnovers the same year. Actually, because of COVID, there was actually a marked increase in their revenue, and relying on those numbers, they made a remittance outside India which was much beyond these limits prescribed. So then they had to go to RBI. RBI did a lot of investigation in terms of what is the activity, how did you acquire the employees, when the remittances were made, what all invoices were raised. Quite a bit of due diligence that RBI did, and finally they accepted that they have made a mistake, relying on the numbers. Otherwise there was no other malified intention. But of course, like sir was alluding to the fact that RBI के पास हाथ जोड़ के जाएंगे, they will listen to you. It took quite a lot of time, almost a year, to get this case processed, but ultimately the approval was granted. So these limits have to be very carefully adhered to when you are remitting from India for an office outside India. Thanks once again. Happy to take questions when sir allows. Thank you so much.